I don't think Saylor will sell Bitcoin. He will stop the dividend on Stretch and just crash the market for Stretch. If you have to sell Bitcoin to pay the interest on the money that you borrowed to buy Bitcoin, then why are you borrowing the money in the first place?
Saylor supporters are saying that this is a smart move.
You can't put all of your retirement money in something that could just blow up and go to zero, because then your retirement is over. He says Bitcoin is going to go up 30% a year. Says who? Bitcoin's not up 30% in the last year. It's not up 30% in the last 2 years. In fact, it's down.
Michael Saylor announced that he could sell Bitcoin in order to pay dividends. So that sent a shockwave across social media. A lot of people are discussing. What was your reaction after this announcement?
Well, first of all, you would have expected maybe Bitcoin to go down on that, but it's hanging in there. It's still almost 82,000 a Bitcoin. But I think he has to say something to try to address the criticism that Stretch is just a Ponzi, which, if he's not going to sell Bitcoin, then the only way to pay the dividends is to sell more Stretch. And so that's classic Ponzi. And Saylor tries to claim it's not a Ponzi because they're being very transparent about the fact that it's a Ponzi. And, transparency doesn't change the nature of what's going on. What separates Ponzi finance from legitimate finance is you borrow money and then you have earnings to repay the debt. But if you borrow money and the only way you can repay the debt is to borrow more money from new people to repay the old people, that's a Ponzi. Whether you want to hide the fact that you're doing it or whether or not you want to be wide open and transparent. Now, part of the problem is, Saylor tells you it's a Ponzi, but then he says it's not. So a lot of people are confused because he doesn't come right out and say this is a Ponzi. You have to figure it out for yourself based on what he's telling you. But a lot of the people who are buying Stretch are not very sophisticated, and they're getting suckered in by deceptive advertising, which suggests that this is some kind of alternative to a money market or a CD or government bonds, just with a 11.5% yield. So I think there's a lot of deception and maybe outright fraud in the way they market it. But if he says that he's going to sell Bitcoin, then at least there's an alternative way to finance it, which is to sell the Bitcoin. But if you sell Bitcoin, well, then you're going to crash Bitcoin. And in fact, if you have to sell Bitcoin to pay the interest on the money that you borrowed to buy Bitcoin, then why are you borrowing the money in the first place if you're only going to sell back the Bitcoin that you bought? And the problem is, when it comes time to sell the Bitcoin back to pay the money that you borrowed to buy Bitcoin, Bitcoin could be a lot lower. So there could be huge losses in addition to the interest that is being paid, the 11.5% interest. So look, I think this whole thing is just a desperate scheme cooked up by Saylor to try to keep this thing going, because the way Strategy was able to buy Bitcoin in the past was selling its own shares at a premium, common stock that paid nothing, or convertible preferreds that had a 0% interest rate. And then he would use that money to buy Bitcoin. Well, that game ended when Strategy's premium went away, and you didn't have a lot of demand anymore to play Bitcoin through Strategy. So he concocted something where you can get an 11.5% yield. And so now the money is not going into Strategy because investors want Bitcoin exposure. They want an 11.5% yield. That's the only reason that he's raising all this money. But now he's using the money to buy Bitcoin. But pretty soon people will realize that 11.5% yield isn't safe, and there's going to be a big loss of principal that's going to offset it. And then the demand for Stretch is going to start to collapse, which is going to force him to start raising the yield to push the price back up, which is going to accelerate the demise of this whole thing. But I think when push comes to shove, I don't think Saylor will sell Bitcoin, he will stop the dividend on Stretch. I think he will just suspend it and just crash the market for Stretch rather than selling Bitcoin and then crashing the market for Bitcoin, which is going to crash everything anyway. So I think he would rather just say, well, we're not going to pay Stretch for a while and let the price of Stretch go down. Now, of course, when that happens, he can't buy more Bitcoin. So Bitcoin's going to go down anyway, but it would go down a lot faster if he started selling it.
Sailor supporters are saying that this is a smart move because it is interpreted as a way to inject confidence into the market, like saying selling Bitcoin is not a taboo. It's something that we can do if we want to, and the market is not going to crash because of it. So basically, taking out the narrative that that Sailor and strategy is a house of cards ready to crumble down.
I don't think that changes the fact that it's a house of cards. I think conceding that Bitcoin may have to be sold exposes it because he was saying they were never going to sell Bitcoin, that they were going to have it indefinitely, that it's going to a million a coin or 10 million a coin. So why would we sell it? But if they start selling it, I think it undermines that whole concept, and it shows that the Bitcoin that strategy holds on to are not permanently out of circulation. He owns almost 4% of the Bitcoin supply, which is a lot, especially in relation to the liquidity to buy that supply on any given day.
But still, we saw that, as you mentioned, Bitcoin price hasn't moved after this announcement. It didn't crash, so the confidence is still there.
Yeah, I mean, Bitcoin has been going up with the Nasdaq has been making new highs. Tech stocks in general are making new highs. So I think, crypto has gone along for the ride. Strategy itself has had a pretty big run off the lows. So people have been risk on. They're optimistic that the war is going to come to a favorable end. I don't share that optimism, but it's in the markets, I think. So Bitcoin is getting caught up in it. We've had a correction in gold. Gold pulled back significantly from 5,600 down to 4,100. It's bounced back. We're around 4,700 now, but gold is out of the headlines now. It hasn't been making new highs, and that's helped Bitcoin because for a while, people were focusing on real gold for a change, and Bitcoin was taking a back seat. But now that gold is pulled back and people are not talking about it as much, Bitcoin has got some of the oxygen back that gold had sucked out.
Let's say a scenario where strategy will sell some of its Bitcoin and the company holds up, the price of Bitcoin holds up. Would that change your opinion regarding strategy being like a Ponzi?
No, I mean it is a Ponzi. I mean, I don't know how my opinion could be changed. The only way it would work would be if strategy started to generate income from its software business or some other business that was sufficient to pay 11.5% to borrow money. I mean, you can't borrow money when you don't have any income. And if you're saying, well, we're just going to roll the dice on Bitcoin and hope it goes up, and then if it goes up, we could use the profits to pay the interest, that doesn't make this a legitimate debt instrument. You're not loaning somebody money that has a demonstrated ability to pay you back. You're loaning somebody money to go gamble, and you're hoping they win. So, um, that's not, a traditional loan, and that's not what fixed income investors are looking for. They're looking for security, stability, safety. Strategy will have, commercials. One of the commercials they use is this woman. I don't think she's real either. I think it's all AI generated, but she's lying by a pool with a drink in her hand. And she says, yeah, I'm retired. I sold my business and I put all my money in Stretch. And now I'm living off the 11 and a quarter, 11.5%. You know, you can't put all of your retirement money in something that could just blow up and go to zero because then your retirement is over. You've lost everything that you've worked a lifetime to save. I think it's very disingenuous, and that's putting it nicely, to target ads for Stretch at retirees who are supposed to be risk adverse. But this is extreme risk. to get this 11.5%. You know? And for Saylor to say that, we're just giving up the first 11.5% and we're going to keep the rest because he says Bitcoin is going to go up 30% a year. Says who? Bitcoin's not up 30% in the last year. It's not up 30% in the last 2 years. In fact, it's down. So based on where Bitcoin is today relative to where it was 4 or 5 years ago, how could you say it's going to go up 30% a year? I mean, you'd be lucky if Bitcoin went up 11% a year. But now you got to give all that to the people who own Stretch. And, if it doesn't go up 11% a year, now what do? You got to give them more than the gain. And then you got to hope that the following year you can make enough to offset that. But there's no indication. I mean, he goes back to the beginning of time for Bitcoin and said, oh, it's 30% a year if you bought it in 2009 when it was pennies. All right, well, you can't really use those earlier years and extrapolate anything. It was a very different market back then and very different valuations. It's easy for something to go from $1 market cap to a $2 market cap, right? I mean, you can't look at that percentage return and say it applies to something with $1 trillion market cap going to 2 trillion or whatever.
For sure, the way it's marketed is questionable. It's shown as safer than it actually is. That's probably something that we can agree on. So you said that essentially, if you are borrowing money to buy Bitcoin that you're gonna sell, then why borrowing money in the first place? But as far as I understand, what they are planning to do is selling just a tiny portion of their Bitcoin reserves in order to inject confidence into the market, then borrow more money and buy even more Bitcoin so that they will eventually be still net buyers.
Well, I don't see how selling Bitcoin injects confidence into the market. It would do the opposite. You have the biggest buyer selling. I don't know how that's a confidence builder.
I wanted to ask you now about your definition of a Ponzi scheme. Basically, a Ponzi scheme is a fraud. So it's a scheme where people are lying to other people in order to steal money from them. So telling them something that is not true in order to steal money from them. But in the case of Saylor, you also admit that everything is transparent. So wouldn't that make the word Ponzi not a good fit for this?
No, because what makes a Ponzi is not the fraud. The fraud is what makes it harder to know it's a Ponzi, right? If somebody lies to you and doesn't tell you how they're getting the money to pay you, if they make you think that they have a legitimate business that's generating a profit and you're going to get paid out of that profit, they've lied to you. And if it turns out that they're not doing that, they're just paying the old investors by getting money from new investors, then you're in a Ponzi, but you were fooled. Now, normally, the only way you would know that there's a Ponzi if the promoter is lying to you is, your spidey sense would have to go off and say, wait a minute, this sounds too good to be true. How could your business earn so much money? How could you afford to pay me, 10% yield, right? I mean, it's got to be too good to true. What's the catch, right? But the difference with the Saylor Ponzi is that he doesn't lie that there's a business that's going to generate any income. He comes right out front and says, we are going to pay the old investors by getting money from new investors. So he tells you that the financial scheme is a Ponzi. It's not legitimate operating income that's going to service this debt. It's our ability to get new investors to give us money so we can pay you old investors. But the problem too with that is the more new investors he gets to pay the old investors, the more new investors he needs because now he's got to pay those investors too. So the more shares of Stretch he sells, the bigger his obligation to pay, which means the more shares he has to keep selling. So the thing has to keep getting bigger and bigger and bigger, which is true of a Ponzi. But eventually you run out of fools. You can't keep doing it forever. And then the whole thing collapses because it depends on an ever increasing supply of new investors to keep paying the ever increasing supply of old investors.
Let's say then that your thesis would just play out only if there would be a massive collapse of confidence into the underlying asset itself, which is Bitcoin.
Yeah, well, that would be a catalyst to collapse it. But also, if people just, start to worry about stretch in the yield or about the increasing burden that paying the yield has on Saylor. Saylor or he keeps saying that Bitcoin only has to go up like 1 or 2% a year, and we can pay the yield forever. True, but that was a snapshot in time when the total stretch outstanding was a particular amount. But as he continues to sell more and more stretch, the burden keeps rising so that the requirement by how much Bitcoin has to rise keeps going up. So it can go from then to 3%, 4%, 5%, 10%. And so at some point, you know, people just might think, look, it's too big a gamble to think that Bitcoin is going to go up that much just for him to be able to pay the debt. And again, if you're going to rely on Bitcoin's appreciation to pay your interest expense, you need to sell Bitcoin to get the cash to make the payments. But the minute you start selling Bitcoin when you're MicroStrategy or strategy, Bitcoin's going to crash. So you can't use Bitcoin to make the payments because you try to sell the Bitcoin to raise the money crashes Bitcoin. And then that crashes Stretch too. So look, this whole thing is destined to implode. And the only question is when. Right? That I can't tell you. The fact that it's going to happen, that's guaranteed. Unless Bitcoin just always goes up and never goes down. I mean, but I don't, I don't see that happening.
Okay, but you also didn't mention the fact that they can regulate the yield at will, so they don't need to keep it that high for sure for forever. They can.
Right, but if they decide to lower it down to 4 or 5%, no one's going to want to buy it. It's not rich enough. That what's sexy about it is that it's 11.5%. You can't get that anyplace else. But if the yield comes down, let's say to what you can get by buying a junk bond, then you'll buy the junk bond because it's less risky than Stretch. So Stretch is paying 11.5% because it's a number that you can't get. It's a too good to be true yield. Why is it too good to be true? Because it's a Ponzi. That's like, you know, that's the tell.
Your thesis on strategy, which is basically the fact that it will implode sooner or later, it's similar to the thesis that you have also for Bitcoin, that essentially they are greater fool sort of games, and that eventually the price will go towards zero essentially. But you say that often these games can go on for a very long time, and therefore it's very difficult to predict when it will happen. But that is a
Yeah.
very easy position to have, because there is no way someone can prove you wrong, because you can always say, yeah, but I don't know when it's going to happen, but it's going to happen. So don't you
Yeah,
think that this
well,
is a bit of a
yeah,
too easy
I'm not
position to have?
Yeah, look, I'm not going to be proven right until it collapses. You're correct about that. And there are other people who believe that, it's going to go on long enough that they're going to go along for the ride, right? Somebody could buy in this Stretch and think it may go on for 2 or 3 or 4 years, and they're going to collect their 11.5%, and then they're going to, get out before the music stops, right? There are probably people who think they'll be able to do that because they think the yield is high enough that even if, it starts to crack, let's say you eventually sell your Stretch and the market starts to fall and Stretch goes from 100 to 90 and you lose 10% on the way out. But if you've collected 11% for 3 or 4 years before you end up losing that 10%, you still came out okay. But, that's easier said than done. I think most people are going to end up losing money in Stretch because the income that they get early on will be exceeded by what they lose later on when they get out. And that's always the case with any kind of Ponzi, right? Most people lose money. But yes, the people that get in early, so the people that bought Stretch at the very beginning, maybe they'll end up getting out ahead. I don't know. It depends on how long it takes before this thing blows up.
All right, now let's move to macro and gold. Regarding the performance of gold during this war, we saw that it didn't perform as a typical safe haven asset as it used to be, because the price is now about 10% lower than when the war started. So don't you think that this is undermining the property of gold as a safe haven?
Yeah, I think that in the minds of some people, the fact that gold has gone down since the war broke out may, in fact, undermine that narrative. And it's not really a narrative, but just that, uh, you know, quality that gold has, that it's a safe haven. But what that ignores is the huge run up that gold had in the 2 months before the war broke out. Gold went from like 4,000 to um, you know, 5,500, 5,600 very quickly, very quickly. Part of that rise was driven by the idea that we were going to go to war with Iran. That was already being talked about in the weeks prior to the war. And so people were buying gold in advance of the war, in anticipation of the war. And so when the war finally broke out, it was a buy the rumor, sell the fact, which is a typical reaction. Bitcoin was the opposite. Bitcoin had been going down the entire time gold was going up. And so when the war broke out, Bitcoin caught a bid and actually rallied. And that's how markets behave. And I know some people now, oh, yeah, gold's not a safe haven. Look, it went down during the war. Yes, but it went up so much in anticipation of the war. Gold is still up a lot on the year. It's up more than Bitcoin. It's up more than the stock market. Gold's having a great year, despite the fact that March was its worst year since 1980. Gold's still doing really well this year. It had a great year last year. So I think gold is a safe haven. It is a store of value, but the volatility has picked up recently, given a lot of the things that have happened. And this volatility is the exception, not the rule. Gold is not typically as volatile as it has been in recent months. But I do think too, the longer the war goes on, the more bullish it becomes for gold. And gold is up today, because there's talk of peace, and that's how it's been reacting because oil is down. But investors still don't seem to understand, or traders don't understand, that the war is bullish for gold. I don't care if it makes bond yields rise or it makes oil go up. War is good for gold because war is financed by inflation. Governments always go into debt to pay for wars. They end up printing more money, and that's all good for gold. Regardless of short-term movements, because of buy the rumor, sell the fact type dynamics. If this war stays around longer, it's going to undermine the U.S. economy. It's going to lead to bigger deficits, more money printing, higher inflation, and that drives people out of dollars and into gold.
Okay, so you basically think that the bottom that we saw in gold, I believe in March, that was the local bottom. Now there won't be any new lows in 2026 for gold?
No, well, I think the 4,100 was the low. I doubt that gold's going to take that low out. I mean, it could. It's not like it's impossible. I think gold's headed back up to the highs. So um, same thing with silver. Silver might take a little longer because silver's high was above 120, and right now it's 77. But people have to keep that price in perspective. Silver had a massive breakout. I mean, it was $30 like a year ago. And so it just broke through massive resistance just below 50 to get up to 120. And it's had a pullback, and now it's consolidating, and it's building a big base above the old resistance, getting ready for the next leg of the bull market.
Wouldn't be a bit irresponsible not to have a position in Bitcoin besides having it in gold in case this debasement trade plays out again?
Well, look, if people buy Bitcoin, because the dollar is going down, will Bitcoin go up more than gold? Will it go up more than silver? Will it go up more than gold and silver mining stocks? Maybe not. So I think I already have a big bet on the debasement trade. I own a lot of assets that are going to go up as the dollar is debased, as people move away from the dollar. Maybe Bitcoin will go up too. I don't know. I don't have as much confidence that Bitcoin will go up as I do that the other assets that I own will go up. And I think there's more upside potential in those assets. I think gold and silver mining stocks have a better chance of going up 5 times, 10 times in price than Bitcoin does. On the other hand, Bitcoin can go down by 90%. I don't think my mining stocks are going to go down that much. I don't think they'll go down anywhere near that much. So I think to the extent I want to have the dollar debasement trade on, and I do, it makes a lot more sense from a risk reward perspective to place my bets on, precious metals and mining stocks and other commodity stocks. I own copper and energy and other real assets that I believe will go up. Agricultural stocks I own. I have a lot of stocks that I think will benefit from a weak dollar and higher inflation. I have no need to throw Bitcoin in there, especially since I don't have any confidence that Bitcoin is actually going to participate. And even if it does participate, it may not participate nearly as much as the stuff that I own.